One of those lenses is, sustainability and your sustainability risks as well as your opportunities. There's the actual operations of the business. Are we doing that the best way we can? And all these things fit together to create a business.
This is a growing town, and I look at here, we've got a huge affordable housing problem. Now, that's one of the biggest growths in sort of private market investment products that we're starting to see come out, which is fantastic. And there's an opportunity, right here in this massively growing, this town that's growing so quickly.
Sustainability is a mindset, it's a philosophy. It's about saying, I want my investments to ultimately improve tomorrow and create a robust environment into which to invest, retire, whatever it might be.
The numbers are frightening of students that there is no accommodation available. So then we decided what we have to do here is convert this into student accommodation, and then the construction of the 3 new buildings.
As a business, we invest in social infrastructure gaps, which primarily includes affordable housing and student accommodation. So the res has just opened as of January 2026. Construction started almost a year ago, February 2025. So it's been heroic in terms of the professional team and the developer in achieving what they've done. So they've gone from 484 units to 1,000, in excess of 1,300 units. Those, as at mid-February, which is where we stand today, are almost 100% full.
We're just trying to get students to strive for that academic excellence. I think, yes, we do just try, create that home away from home experience for all our students that we get.
Ladies and gentlemen, welcome to episode 11 of Inside Private Markets here on EBNet Stream. We have spent a good number of months talking about private markets, the investment opportunity, the risks that are associated, and today we want to talk about the third element of what can be achieved through investment in private markets, and that is called impact. We will unpack that for you and hopefully allow you to understand that you can achieve great things with your capital while also achieving good returns for your members. So joining me today, 2 people I don't need to persuade on the value of impact and private market investing. First of all, we have the head of sustainability for Old Mutual Alternative Investments, Tanya Swanepoel. Tanya, welcome.
Thank you. Glad to be here.
And then the founder and head of Paragon Impact, Brett Wellington. Brett, welcome. Right, guys, where to start? Most trustees or even their advisors tend to think that if you're targeting impact, it's something philanthropic. So you by default are going to give away return. The world has moved on. That's no longer the case. Maybe it was many years ago, the experience, but today that's no longer the case. In fact, Brett, you built a business based on the fact that impact at the end of the day can also be your highway to good returns. So can I maybe ask you to come in at the start and just explain this third element, impact? Is it indeed a way of producing return, or will you be actually sacrificing anything?
Yeah, thanks, Leon. I think, maybe just to start off with, the main thing is, the world has been focused very inward looking in the past. So looking at a sort of standard externalities approach of companies where they kind of didn't take that into account. So it's always been looking at it from what's the risk to me, as opposed to what is the actual impact that either my investment or my business actually has going outwards. And I think that's where we've moved on too, because we live in a 3D world, and when you only look at risk and return, you're kind of missing the third element you've just kind of alluded to there, and that kind of brings in the element of impact. And so for me, that's where it's really shifted in. Philanthropy was a typical way of looking at impact, and that it was this money you had to give up to have an impact, and it was kind of like sort of a side hustle of a company. Maybe it could be a CSI, or it's other big funds or so on. But now it really is very much about, well, what can I do within my business, but also having those positive impacts. And you can actually generate returns. And in fact, it's about really generate more resilient returns. There's volatility in any market. And what you find is when you start to bring these things into measurements as part of your investment decision, you also can really actually look at resilience as being your beneficiary. So yes, you might not have sometimes significant spikes. We only have to look at the recent things happening in the world around wars and the spike in coal prices and oil and all kinds of things. So all of a sudden, that's kind of the star child from from an investment perspective. But that'll spike and it'll spike down again and it will drop. Whereas what we find around the impact perspective, when you consider that, we're always going to need jobs, we're always going to need energy, and so when you can, put that into ways that perhaps don't have such negative externalities that haven't been factored in before, the more resilient these returns will be over time. So it's almost about flattening that volatility a little bit is the way I see it.
So if you think about it, you have an investor, be it a pension fund or an individual, they might rely on a consultant, an advisor who would help them select probably a professional investment manager. That investment manager will then assess the investment opportunities and invest in companies. You mentioned businesses. Now, impact or sustainability, if I can use that term in as a lens, when either investing capital for your company or investing your own capital into companies, is a way of building tomorrow so that you have longevity, you have I can't remember the words you use, the sustainability, not sustainability, the robustness of resilience. Thank you. Yeah. Resilience of the future. So it's not so much about being charitable in its nature. It's more about building the future that you need in order to remain being successful in what you're ultimately doing. So I always have this debate with trustees. I'm interested, Tanya, with your view on this. I have this debate with trustees where I always ask them, what is your primary duty? And they'll say to help members retire comfortably, and that's 100% correct. Now, how do you do that? Well, it's about producing the right returns without them going on such a bumpy ride that they panic the whole way in getting there, and they leave it at that. And I say, but what happens if they retire with lots of capital into an environment where there's social unrest, or the cost of healthcare is extreme, or the cost of inflation is very high, and therefore the cost of living is difficult. I mean, if you take South Africa as an example, a prime country where impact is needed, we pay for our own security, we pay for our own private medical and so on. These are all things that impact on a healthy, happy retirement. So maybe comment on that in terms of sustainability and impacts, not about being charitable, it's about sustaining tomorrow.
Yeah. Exactly. And I mean, you've mentioned some of like the long-term effects, but they're also shorter term. And, Brett mentioned that as well. So I think about it from two different lenses. And so the one is actually managing your risks today and to the future. So there are certain ESG, we'll talk about ESG and what that is, but there are certain environmental and social risks that can affect your project today. So it could be delays due to unrest, etc. So it's looking at managing those risks both now and looking ahead. And then the other thing is, or maybe there are two things. So one is making sure you're assessing, so i.e. identifying those risks, assessing those risks, and then managing them. And then the other side of the coin is, what are the opportunities, that this business can provide, and how can we maximize those? Again, with that balance, So how can we maximize those while maintaining certain kind of credible practices, So yeah, we're doing things in the best way possible.
So let's talk about that positive side of it, where you mentioned the opportunities that it creates. So you could have a company that has a sustainability mindset and manages itself in that way that might be more popular from an investor perspective for various reasons, or let me start there. So why would a company with a sustainability mindset perhaps be more attractive to an investor?
So I think, again, it comes to that resilience piece. So you're thoughtfully looking at your investments from a number of different lenses. And one of those lenses is, sustainability and your sustainability risks as well as your opportunities. There's the actual operations of the business. Are we doing that the best way we can? And all these things fit together to create a business that is going to be profitable, in the near term as well as in the long terms. And from our perspective, it's important because we're managing these, we enter these businesses, we manage them while they're part of our fund, but then we're wanting to exit so that we can have good returns. And the idea then is to hand over a business that is in a better position than when we went into it.
And a business that looks at its scope more broadly and also invests in its community, ultimately creates the customer of tomorrow for it to continue to ultimately grow. So Brett, on your side, if there's a business that focuses on solving an impact issue, okay, where they have to target a particular impact, why might that be popular to an investor?
Well, I think there's a number of different things. We talk about these different capitals. If we understand these, there are these things like the 6 capitals. So you got things like reputational capital, social capitals, not just financial. So I think from an investment perspective and the economy that we operate with in South Africa, there's a lot to be said by the impact that you can have and the attraction you might then bring because of the impact that you're having. So we just got to look at. I operate here out of. I'm very blessed to work out of Hoedspruit and travel into Joburg now and then. But this is a growing town, and I look at here we've got a huge affordable housing problem. Now, that's one of the biggest growths in sort of private market investment products that we're starting to see come out, which is fantastic. And there's an opportunity, right here in this this town that's growing so quickly. Now, put together an affordable housing product where people are now starting to live in shacks, that weren't here before. You're starting to find that there's various issues that are starting to come up. There's starting to be things like crime that wasn't much of an issue here. You're starting to see things like a lot of illnesses creeping in because of obviously the unhygienic ways of living. So I think because of that, you're starting to see people are being innovative in the way that we can pull different things together, like affordable housing, into traditional finance products. I know it's alternative in the form of maybe someone like Tanya might be doing, but in the long run for South Africa and our existing needs, that thing becomes from an alternative thing into actually quite mainstream. And so, huge opportunities lie in that, but at the same time, really solving for a significant gap that we need in the form of that being an affordable housing. And that's just one.
I think that's a great example. So let's take affordable housing. You invest in affordable housing because there's a demand. So you meet that impact of that demand, which the people require. Otherwise, they will live in shacks. And if they're living in shacks, there'll be health issues, there'll be security issues, so there'll be the negative of it all. But if the affordable housing is built and the people come, there will be the rentals that are ultimately achieved through that to give a good return on their investment. And then there'll be the additionality of other companies seeing the opportunity to provide security or to provide healthcare facilities or whatever it is. And through that, you build the community until you have built the city, if I could put it that way. in its own right. So that's a classic case of where impact is targeting where there's a demand, and if there's a demand, you should achieve a return. Hence, it's not philanthropic in its nature.
Yeah, and I think scalability comes in as well. Because at the moment, what you've got is sort of opportunistic people and landowners who try to take advantage of people who are quite desperate. Now, when you scale that into a sort of proper commercialized product that has, well structured, parts of that, something, like an Old Mutual would be able to do, you suddenly see things are operated far better. You'll find that people are not as, these are like some of these, I'm kind of assuming some things here, but it's just based on stuff we've obviously read and researched over time. Less absenteeism from work. People aren't getting sick as much. They're living in environments they're actually able to sleep in. So the spin-off effects of that is that actually, although you might not see it directly for your own product, the economy actually benefits from a better operating environment for South Africa and the problem that we have courtesy of our history.
So let's before we go, I want to talk about the negative side of it, but the another positive example, perhaps Tanya, I can put you on the spot. Just like we unpacked the affordable housing leads to strong returns because of demand and then the additionality, could you try to unpack another example similar to that?
Well, very similar to that is education, and the same thing. It's around affordability, and then also how to deliver the best results. And some of it's not as it is new for many people, but we've actually been doing this for quite a long time in South Africa. So within our funds, so when I say our funds, Old Mutual funds, but broader than that as well. And then the other obvious one from our perspective is renewable energy, and the growth that the renewable energy kind of sector in South Africa has been able to achieve through private investment. And that kind of, again, that demonstration of both positive impact as well as solid returns.
So I'm going to come back to impact themes, and we've already mentioned 3 just in the conversation: affordable housing, in fact 4, healthcare, education, and renewable energy. And we'll come back to more on the climate side and so on as well. But before we go there, if a company does not have a kind of, I wouldn't say an impact mindset, but a sustainability mindset, i.e. we don't care about the environment and CO2, we'll pay the fines. Or we'll dump our waste as we see fit, or however we can act in order to get around the legislation so we don't get into trouble, but we do the minimum necessary. What would the impact, Brett, be potentially on a company like that tends to ignore it? How could things pan out for them?
Yeah, it's a real problem you've highlighted there, because it is the lack of responsibility that they've been allowed to actually have in terms of the environment. And that's unfortunate, because what starts to happen is that, when we don't regulate ourselves, regulation kicks in. It actually just increases the cost of business anyway. So that's kind of like a side thing. I think for me, these types of things, I see impact as, I think a lot of people see it as like something that it's this do good component, but it's actually one of your best lead indicators to risk. So in the example you've given, if we don't care about that and the way that, for instance, us as Paragon, how we measure these different types of impacts in different categories, you might have certain impacts there, like waste, for instance, that's going into the water. That could come back to bite you. Yes, it might not bite. You might get away with it now. But as regulation kicks in, and then other things start to come in time, that will start to reduce your social license to operate as well. I think we're getting into an environment as well where, because of I think social media to AI to all these different things that are happening, you can't hide away from that much longer. It's going to catch up with you. So my idealistic view is that you'll get caught out sooner. Unfortunately, a lot of the time it does happen later, but then it can be quite catastrophic when it does start to happen, when you are caught out with these types of things, and then the loss of business that you get. So, from private markets perspective, there's a lot of pressure on private markets to be obviously aligned with certain international standards in the way that they are allocating capital, especially if it's coming from offshore funds, but then also even internally. So it's going to really reduce your ability to access capital. And so your access to capital is going to start coming from a much smaller and smaller sort of group of investors that are going to be willing to take those kind of risks in different forms of thing, whether it's reputational or futuristic or future financial externalities that will then start to come and bite you, later, which could be an environmental impact that hits you in a social way, in terms of a community that does an uprising and comes and destroys your factory because you're poisoning, the very community downhill. So you don't just look at the fact that we can get away with it with maybe this department or that, because we see communities take matters into their own hands.
Yeah, but even with the Trump denying climate change or calling it the Great Green Hoax or whatever, the world has accepted it, and companies are having to transition. So you can maybe be a CEO with a very short-term mindset, because the CEO terms are so short these days, and think, let me maximize profit, maximize bonus, and move on, and who cares? The reality is that company that the investor's in for the long haul, right, is going to pick up that cost of that transition. They're going to have to filter that in. So surely asset managers, the guys that we pay to do the assessment of these companies, short and long term, have to be factoring into their models the cost of the change, the cost of potential social unrest, or at least the risk of it, and so on, within those spheres, and at least asking the question. So the question I would have, to me, that makes sense. Maybe Brett Storr with you, and then I'll come to Tanya.
Okay, I was just going to...
Sorry,
I was
let's
just
change
to
it.
add
If you're biting at the bit, we'll go to you. Are they doing it?
So, well, to me, it's that chain. So if I'm an asset manager, I'm an investor into a company, and that company is not, is behaving like you've just described, then puts the money that we've invested in them at risk. It then, in turn, we have to update our investors, around what the performance of the company is on a number of different factors. And we then also need to be able to go back to our investors and demonstrate how good we've done. So, it doesn't just affect that business owner's ability to raise capital in future. It has this long kind of knock-on effect to the rest of the whole chain of, the way this industry works.
But I find
our pension fund investors we're maturing, so maturing around the questions they're asking when they're sitting in our ESG subcommittee, meetings, those kind of targeted questions that can drill down into these investments. So there's this long chain of risks that you can, a domino effect. Yeah.
To me, ever since I've been involved in private markets, terms like ESG, sustainability, impact have been right at the forefront from the start, that I'm going back now 6 years or so. Not so much on the traditional listed side. So I also had a look at that report done by Just Share a while ago, where they rated the asset management community, and the scores are quite shocking to see. There's a sort of absolute level. Now, either the report's a bit too strict, or the managers are paying lip service ultimately to this, and surely that's going to cost investors over time. Either we're going to have a continued shrinking JSE and more take on of private markets, or alternatively, there's going to be a shock in the system at some point in time, but these guys aren't factoring this into their models and pricing it accordingly, Brett.
Yeah. And Tanya, I'd love for you to correct me if I'm wrong. With obviously you've got far more experience on the private market side, but I mean, what I see perhaps is that on a private market side, you're looking, say, for instance, you're looking to exit. You're exiting 7 years away, typically, all right? I suppose it's around a 7-year time that you're looking to exit. So you've got a long term. Even 7 years is not long term. It's probably more of a medium term sort of element, but at least it's better than, the next quarter. And I think that's what the traditional markets still have not changed in terms of how they are measuring performance, is they're still looking quarter to quarter. Even from a pension fund perspective, we're sort of updating on an annual to a biannual strategic investment day, and we update everyone. So there, the pressure is on to perform on those quarters. Now, we just had, again, if I go back to my original example around the fossil fuels and coal prices and I suppose the surge in performance across a lot of these extractors at the moment, driven by where we are. I mean, I've been in a number of meetings where you kind of go back and say, well, this is great, but don't tell me not to have exposure to Sanlam, or not, at least I'm not Sanlam, sorry, Sasol, and increase my exposure to Sasol massively, because we got to run while it's hot. Now, immediately there, what you've done is you've completely taken that ESG topic or that impact element of the significant amounts of emissions that it has. Now, it's a very important company in the South African economy, don't get me wrong. But just the way that we then consider that, you park that ESG issue out, that impact element of being one of the biggest carbon emitters. From our measurements, we know they're sitting one of the highest percentile emitters per $1 million of revenue. So we just park that, because for now this quarter I can report, or this, that we haven't missed out. And so as trustees, we then ask, well, we if we didn't participate and we didn't increase our exposure, we've missed the boat. Everyone else is generating the revenues. And maybe that's the case, but when it drops again, and that volatility hits, then where you are you then upset that you're so exposed to that volatility, or not? And I think that's where, for me, the maturity that's already come into the private markets of how you're looking at a much longer timeline, and you talk about a domino effect, need to come right up to the pension fund level on traditional markets to also then trickle down. That we are saying to our asset managers, we are saying to our investments advisors, look, we don't want you just to go, run with the market now because all of a sudden, we nervous around access to oil, and be a little bit more long-term oriented, because a pension fund is long-term, right? It's about people's, what they're going to retire into. You said it very nicely at the beginning, Leon. So for me, I think that's the difference, and I think where traditional markets can learn really nicely from the private markets, and how they're looking at this in a much longer term view than the next quarter.
EBNet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally, for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you're enjoying the content. That way, you help us help you. Thank you from the team at EBNet. For more great content, please visit www.ebnet.co.za.
And so, Tanya, before you come in, as Brett's been talking, I've been thinking in my head about, we tend to see these things in absolute terms, right? So we don't have to see Sasol as, bad actors, don't go near them, but rather, what's the plan? So if there's still a good financial case, what is their plan? And to be active citizens, or active, and I put asset managers in the same bucket then, for them to relay the communication, to ask for plans, to see and to make sure that it is factored into their model, so that it does impact the supply and demand of that particular company, so that management starts saying, well, hang on, my bonus is actually going to be impacted by these things. And then so it doesn't need to be a slap. It's just a normal course of events that things happen. But if we're not asking the questions, or we simply say we're not going to look at that because we don't like the answer, well, then nothing will change.
Yeah, exactly.
And I think the thing that's about being engaged, as you say. So I would much rather that our strong investor community that we have, that has the right responsibilities in mind, are staying exposed to Sasol, to be active owners with them, asking the hard questions and saying, listen, you've got the capital, you've got the experience to adapt with the market and where it needs to go in the form of reduced emissions and so on. I mean, just look what's happening in Europe with the high temperatures there. They're feeling it right now. So we would want that. So it's about that engaged process. I'm certainly not, as you say, it's not about like, you divest, you'll just get people who don't care as much. So it's more about let's have this engaged process where we can, partner together on this.
I feel privileged in a way to be able to be working in private markets in that sense. It is a journey that you go on with your portfolio companies, targeting what is material to them, or what we think. And when I say we, I don't mean just us versus them, we, us together. What are the material risks associated with this business that we need to manage, and what is the plan to do that? Is it going to take us X number of years? How much money is it going to cost, or how much money is it going to save? So kind of developing those plans alongside the portfolio companies. And yes, it's that advantage of, sometimes it's fewer than 7 years. But for some of the open-ended funds, for instance, you're going to sit with that asset for 20 odd years. So, yeah.
So you mentioned the temperature in the UK at the moment. I'm taking my daughter on Sunday to the UK on what she calls a shopping trip. So I can assure you the temperature's about to go through the roof, and I'm not certain I'll come back alive. But
at least there's aircon.
Good luck.
I was joking. I was saying it's going to be the only hotel room in London that doesn't want to open from the inside. We can't go out. So, while we're talking about my daughter, the generational change that is taking place, how real is that? Is the next generation, do they care more about these factors? Do they care more about what happens with their money rather than just the return that they'll get? So, Tanya?
For me, the easy answer is yes. But again, you can also from that perspective, you have the whole suite, right, of views on that. But I think their lead time is a lot longer than ours. So the interest in making sure, again, and we were talking about it, earlier, that the world that they retire into is livable, is maybe not something they consider right now, but yeah, it's definitely a longer term view. So yeah, for sure.
But even still, you take the generation that's coming through now, most of them would not buy a petrol powered car. Naturally, especially overseas, they would immediately go to an electric car because that is their only choice as far as they're concerned, kind of thing. Different in South Africa because we're not quite there, but that's starting to come through in terms of what companies need to consider their future market to ultimately be. But we were talking about listed companies, and I want to come back to the private markets, and I want to unpack sustainability, ESG, and impact, because we need to get that down pat. But the listed markets, we're losing listed companies continuously in South Africa and globally. Is that not part of also just the natural course of events, that has become so short-term in its nature that the people within that space are starting to say, I'd much rather be private. I'd much rather have a longer-term mindset, and then I can apply principles like this. So is it not in the interest of the listed markets to actually start what's the right word? Correcting themselves, putting in place the right longer-term measures, stopping the short-termism in its thinking in order to allow these things to happen and remain relevant? Right?
Sure, that's a big question. It's $1 million question because I think a lot of the delisting causes as well is the cost of listing, in terms of regulatory compliance, all these types of things. But that is also driven by the very fact that because they haven't self-regulated properly, that's obviously over time that you've got these listing requirements, and then the JSE, for instance, will put their sort of their requirements around sustainability reporting as an example. But then you've also got other. So that all is as a result of not self-regulating. And so what then starts to happen is that because it's put on you, you then start to point the finger outwards. And then over time, this price pressure of listing goes up. But then what you have is, I think, on the private markets now, obviously, that you've been driven by not a stick, but more of a carrot, I think, in that you don't have the same level of regulation, but the level of uptake is, a bit better because you're driven by a carrot. And now, unfortunately, on the other side, it's still stick driven. So you obviously want to move from the stick to a carrot. And then rather do things and spend money in the right direction of things. It's actually going to help you, as to Tanya's words, find the opportunities rather than focusing on the risks in the listed space, where it is still very much a bit of a risk. You talk about ESG, still very much ESG, very much, if you had to say ESG and impact between private markets and corporates or listed listings, ESG will fit probably more into that one, and impact fit more into the private market side. So it's almost like we've got to catch up and re-look at it, but in fact the regulation just keeps pushing up and up and up and up, because you've just got to it's just the way that it's gone. But to a degree, it's a good point, but I'm kind of talking myself out of the answer a little bit.
Maybe there's also the opportunity there around the kind of, again, looking at what is important and real kind of, because I certainly, what's a challenge for us is reporting for the sake of reporting, and we don't even, there aren't that many requirements in the private markets. However, even here they can be quite onerous, and then you start questioning, is this helping or heeding? And perhaps that's exactly the trap we're talking about here.
So I give you my opinion in terms of what it's worth. The entire value chain has to come together. Now, the value chain in private markets is a little bit more organized now, and Brett, you're spot on. It's more of a carrot. So everyone from the capital owner through to the investor, being the asset management company, through to those receiving the capital, have a sustainability sense or impact sense, because they've actually seen this as the opportunity, and everyone's aligned in that regard. So we're all working together. So a report is not a report for the sake of a report. Okay, the report is for the sake of, are we on track? Where are we going? What are we achieving? All of the other aspects. Where in the listed space, no one's asking that question. The asset managers are more also worried about short-term performance. So there's a short-termism that's being driven all the way from the investor's perspective. Okay, surveys that are done and whatever. So, Brett, sorry, but you can speak to the guys at Forbes and tell them to stop doing their surveys. It's never going to happen. Okay. But the reality is, if we're able to bring that to a longer-term mindset, the same thinking would come into it. Until there's brave CEOs who start saying, you know what, my business model is dependent on a sustainability mindset, and therefore I need to apply myself differently, and I will take on the personal risk in the short term. It's a very what's the right word, brave place to go. But anyway, let's unpack this. Sustainability is a mindset. It's a philosophy. It's about saying, I want my investments to ultimately improve tomorrow and create a robust environment into which to invest, retire, whatever it might be. So I want to achieve more than just the return in the short term. I want to build something over time. Now, how do you apply that? Again, through the value chain, everyone can look at ESG principles, because ESG principles say to you, these are the good behaviors. From a governance perspective, from a social perspective, these are the things you can be supporting, which will mean that ultimately you should get a better sustainable picture that comes out of it. So as a trustee, you can ask your asset manager questions around that. What are you looking for? How do you price this within your models? Do you question your your investee companies on the following basis? You can even go as far as saying, how do you vote on proxies and so on when it comes to these kinds of factors? These are all how ESG is not a swear word. It's actually a tool, and it's a guide to ask good questions and to understand everyone in the value chain. Then you come to private markets, where again ESG is a guide to understand what you're investing in, what the output from that will ultimately be, but it's also where you can directly target specific impact. It's where you can take sustainability to a rifle shot to say, right, I want to impact the following things. I want to see education improve in South Africa. I want to see climate change mitigation in the following way. And then I'm choosing to go there as an investor, or even as an asset manager, I'm choosing to go there. But you can't go there without measuring it. You can't just say, I want to go there. Right. And you should never accept anybody coming along to say, oh, yeah, this is a lovely thing and it's going to achieve fantastic results. Well, what are those results? How much, and how are we going to measure it to make sure it gets there? Should surely be the questions that we ask. So do you think I've captured sustainability, ESG, and impact in the right way, or is there anything I'm missing there?
I think, fairly well. I mean, I see sustainability as almost the holistic picture of it all, as you're saying, it's really that, just, is it sustainable? Is it going to, in 10, 50, 100 years from now, whatever we're doing today, is that going to be the case? And can we still operate for that? To understand that, I got to know, right, what are those environmental and social issues that could be a potential risk to that business model? Continue going forward. So inward looking, all right, well, there's carbon pricing coming in on this. There's, all different things that might be from environmental, then obviously on the social side, there'll be various components around, social unrest, whatever it might be, considering our labor markets. And then on the other side, okay, well, what is the impacts that I have that could actually either mitigate or make those potential risks even worse? Or at the same time, what are the components of that that's actually an opportunity for me in a shifting market that's maybe changing, and we need to actually sort of pivot in our business model to be more sustainable over time. So I whether it's correct or not is not maybe shared by everyone, but I find the way I kind of you do it is almost like, as you say, ESG, kind of very inward looking and impact outward. But they're rotational, because the impact that I can have will come back in the form of a risk, maybe not today, but in 10 years from now, that could come back in a different risk. Environmental impact has a social risk, maybe, or still an environmental risk. So so I think so. But I think a lot of the time we've been kind of driving with one eye closed, only looking at risk and not actually understanding, the potential impacts that have been had. And by doing that, missed risks, but also missed opportunities. I've been involved only a little bit on some of the private market stuff. And so one of the affordable housing ones, going back to what we talked about at the beginning, what is fascinating in doing the sort of impact analysis we did on that particular project was, by not only having an affordable housing product that was benefiting, maybe it's actually student housing, it wasn't really, but affordable student housing was also around how they were focused on more sort of greener building requirements, also made the building more efficient, both in having it built. So these interesting polystyrene brick things that they create, it's quite like a recycled thing, to truck it and get it there, they're much lighter. It's not like you're bringing in a whole bunch of bricks. So the actual transport is lower. The cost per brick was lower. The building and the way that it's done needed less cement. So there was less cement. Probably the biggest thing. So the carbon element of it was far less. Carbon cost of it was far smaller. They're much better with the insulation. So it's amazing. Like, once you go down that road, all of a sudden these efficiencies start to open up, and you can actually be lower costs and even drive up future profits even better than you probably could have if you just stuck to the same old way of doing it in the past. Sorry, I went down a bit of a...
No, I think it's fascinating. It's fascinating to talk about examples like that, and it's good that we do, because it's when we ignore it that we don't see it, and we don't realize just the latest technology and how it can benefit us in that regard. But I want to ask Tanya the question. We've spoken about renewable energy. We've spoken about affordable housing, student accommodation now. We've mentioned education, healthcare. Can you try just rattle off a couple of other, call it, impact themes that people could target, both here locally in South Africa, but also offshore, where the market has matured a bit?
Oh, I mean, you could almost just take the list of sustainability, sustainable development goal lists and kind of go through those. But, the others, if we're looking at South Africa's needs, and there are examples elsewhere, water, for instance, is key. And you've mentioned renewable energy, but infrastructure as a whole. So if you're looking at digital infrastructure, ports and logistics, there are a whole host of opportunities. So it's around what are those kind of building blocks that build a economy and a functioning society, and how can we layer on opportunities that can have both that positive and return solution.
And from a climate perspective, I've heard terms like circularity or what else is there? Adaptation type opportunities. Brett, can you give a couple of examples on the climate side, what sort of impact themes there might be?
Yeah, I think, on the impact side of things, there's real opportunities with carbon sequestration projects from an investment. I think with South Africa in particular, with our rich biodiversity and some of our history. So there's different ways that you can bring that climate element into it, like you're talking about. So either coming from a mitigation side in terms of alternative arrangements, or others through projects that you are sequestering carbon into the carbon market, but and you're selling it in, and there's monies to be made there. I'm involved in a very interesting project, learning a bit about it, I should rather say. And then you're looking at what I think it's RMB with the water bond down in Cape Town, and starting to make that into a real investable product around that. So not necessarily that will have climatic benefits as well. So there's very different things. I think a lot of the time we just think, okay, renewable solar panels and wind, but there's different things different ways of doing that. And I'm definitely seeing in not only in South Africa but in the African markets, our rich biodiversity and land that hasn't been as altered as Europe and others is a huge opportunity going forward when you look at the climate issues we're facing. And so in order to rectify that, Africa, we always talk about Africa's got rich resources, but we're always looking underground. But one of our biggest resources is what's sitting above it.
It's interesting. I studied it was in the Nordic countries, entrepreneurs who created businesses out of waste management. You'd think something like that is yesterday. We would come up with a business in relation to that, but the new technology is such that it's new technology, it's new opportunity for people. Tanya, you going to say?
Yeah, no, I was just that natural resources. Yeah. Exactly.
So I also always find it fascinating, the concept of additionality. And additionality it's a positive thing in the sense that you go build, you then create jobs, you then, end up building a community around it. So it has knock-on impact, essentially, to improve people's lives. But sometimes maybe not. So there can be a negative aspect of it. And I always use the example that this machine over here has revolutionized our lives until I watch my children on the weekend with their nose in it and you can barely get them to look away, kind of thing. So what are some of the negative additionality issues that we need to look out for when investing in impact type investments? So if we're building a shopping center in a rural area, what could a negative impact be, Brett?
Sure. You've just touched on such an interesting topic there with the cell phone, because immediately it also made me jump to AI and the unintended consequences that we're now seeing on AI, and going back to climate, what you just mentioned. So it's going to fast track a lot of things and make things a lot more efficient, but it's having a very negative unintended consequence we're going to have to manage very carefully. But I mean, it always comes down to these unintended consequences that you might have when you're doing certain things. And I think that's the key thing around impact, and Tanya said it with the 17 Sustainable Development Goals. The good thing about that, and one of the reasons we use it as our overarching framework as well, is that if you just are too focused on one element of impact, you're going to miss out what the unintended consequence could be somewhere else. So you've got to understand these sort of interconnections that happen between them. So it's funny you're talking about like a new shopping center. So looks like we've got one going up here, a brand new one. that's going to be going up. But immediately, what everyone's worried about now is what it's going to do to traffic, what it's going to do to the already very constrained sort of water and sanitation issues that we have here. So it's going to add a lot more, and those water and sanitation, it's just not going to be able to handle the flow. But of course, then there's going to be other things, in terms of the local community. I talked about low cost housing, but what you tend to find then is whatever shebeen is around, maybe is going to maybe fall out of favor because there might be now a new bottle store that opens up there, and maybe that impacts local, sort of local business, and it supports now rather a big brand that's now pulled in there and can compete. So I'm going down a bit of a path there, but there's always
it's a hell of an important part. So when it comes to any investor with a sustainability mindset, there has to be the goggles need to be broader than just a primary what's the right word, target that you're setting. So Tanya, when it comes to Old Mutual, private equity, or AIM on the infrastructure side and so on, when you look at a project, okay, there's often an impact thesis that you have behind that, but how broad does that thesis go? Is it a primary goal, or how broader do you look to see what the additionality impacts are?
Yeah. So, I mean, there's a primary thesis generally, because we're wanting to tie our impact, if we're talking about impact investing, we're wanting to tie our impact to the actual operations of the business. So, i.e., the better the business does, the greater the impact associated, with that. That's how we have visualized our approach, and there are different ways of looking at it, but that's how we've looked at it. But I think part of what you guys are highlighting here is that again, that it's almost like environmental and social impact management lens. So you need to, if you're going into a business, again, be looking at a number of different aspects of that business to assess whether you're managing all those, both intended and unintended consequences. So it's a little bit that risk mindset, I think, for when we're thinking about investors, shifting that slightly to a risk lens when you're thinking about environmental and social impact. So, it's just a different way of looking at it, but you have to cover all of those aspects. So if we're looking at a business, we do an environmental and social due diligence on that business. We get the proper experts. So if there are risks that, perhaps there's a wetland in the area and we don't have a wetland specialist in-house, that's just not, you make sure you have the proper advice, from experts in terms of how can we manage, any unintended effects properly. You look at tax, you look at legal, you look at operations, you look at technical. So again, it's just making sure that we're not that kind of narrow compartmentalizing, the effects of these businesses.
And you've captured for me why I think ESG is so important, because all of these things that you talk about, you've got to weigh this up, you've got to weigh that up, you've got to understand, you've got to investigate. They're actually natural things to do when managing a business or investing in a project, whatever it might be. It's doing your due diligence. That's the reality.
Exactly.
The difference now is ESG just gives us some pillars to guide us of what to ultimately look at. So I come back to where people
language
tend to
and processes.
Where people ignore ESG, they ignore it at their peril, because it's there to help them ultimately manage their business accordingly. They might choose to accept a risk. That's okay. All right. But the reality is identify the risk. Don't just be blinded to it. Now, often they're doing that in any case. Okay, they just don't call it ESG. So ESG is not a swear word. It's actually just a formalization in some way that the entire value chain can fall back on something in order to make better decisions. But then it comes to the final point for today, which is the measurement of it. And Brett, this is where I want to bring you in because it's your area of speciality. I'm a big believer in the fact that impact, well, sorry, let me reword that, be careful. Impact's the easiest thing in the world to sell. Okay, because it's kumbaya and everyone wants to jump on board. Okay, as soon as you've gotten over the fact that it's not philanthropy, we should all be very happy to support it. However, that's easy to sell. Right? It doesn't mean you're necessarily going to deliver on it. And these investments tend to be longer term, and you're only going to realize whether it's really happening or not if you don't apply your mind to it in year 7 to 10 kind of thing. So when looking specifically to target an impact investment, what is the absolute do not ignore that you would advise clients?
Well, I mean, probably just broadly what you just said around measurement. A lot of the time, I think the concept of impact, people sometimes get very nervous of because they feel it's not measurable. It's very difficult to measure. How do you assign an impact that it is due to that? So that job creation, that job you created has had this impact related to whether it be reduced inequalities and as a result in, the sort of education that's been in the household, whatever it might be. So, I think there's been too much focus on impact in terms of measurement and that it needs to be perfect, and it can't be. We have to make some inferences, and so I mean, as scientists, I mean, I'm a sort of I suppose a scientist by trade, not an economist, and so when we've been studying these things for a long time in terms of the impacts that are related to certain things, and so for me, it's about pulling together a framework which is what our whole business is about pulling in together and getting some measurements that can give us a very strong indication of what that impact is. What we're measuring really is the output, ultimately, and then what we're saying from there is, all right, that we can get a measurement on. There's fairly consistent measurements we can start to get on that. The next step is what kind of outcomes and then as a result impacts, which is probably going further down the time horizon, can we really with confidence assign to what is happening here. And there's plenty of scientific ways that we've now done that to pull that together to give a sense. And with South Africa, I mean, one of the strongest ones we've got literally one of the worst unemployment rates in the world. So you talk about additionality, and so every job that we are creating in this country has a very strong piece of additionality tied to it into reduced inequalities and so on. And there's a fantastic company that we did some work with in the very early days in terms of job creation that was a very, very clear additionality to a local community in terms of investment there. So I think that the do nots is don't be scared of measurement. Lean into it, do it, and you'll be surprised what you can get out of it.
Also, a bit of muscle memory. I mean, if you think about it, we started off back in the 90s, money-weighted returns, time-weighted returns. Nobody knew what it was all about and how it worked. We worked it out. Then everyone got all fancy about risk. And now you have value at risk and volatility and downside and every risk you could possibly think of, and not certain how to apply it in any kind of analysis. This is another imperfect form of assistance where with the right advice, it will help you make better decisions at the end of the day. Much better than putting your head in the sand, because then you can quite easily be taken advantage of. And there are measures, number of jobs created, number of CO2 emissions reduced. There's everything can be measured in some way, shape or form, albeit imperfect. And there are measures that I feel are quite tangible for us as humans, where I struggle to touch value at risk. Okay, I can say, we created so many jobs, which is fulfilling in its own right. So on that note, Tanya, I'm going to give you the final word, if you don't mind. I see we've run out of time, and then we will close off.
Yeah, so just to carry on with that, I think, that aspect about it not needing to be perfect, and also don't get too fancy. So you make it as practical as possible when it comes to measurement. And when we're talking about context, and it's something that Brett, you've alluded to, context matters. So the context in which you're investing and why you're investing and the scale of the impact you can achieve is determined by the context. So if there's, if you're doing an upgrade to a road, if you have miles and miles of perfectly paved roads, makes hardly any difference. If you are in a rural area where the road is connecting a village to a hospital, for instance, significant impact. So keep those two things in mind.
Guys, thank you so much. I love this conversation. It's such an important conversation that we're having, and it's one that I'm finding myself in more often these days, which is fantastic, because it means the market is slowly but surely moving. And I encourage all of our listeners, whether they're trustees or consultants, to engage the subject. You don't need to become an expert, but you need to be part of the discussion at the end of the day, because together we ultimately grow the South Africa, if not the planet of the future. And these are all pressing needs that we have, and we've got the ability to address them. And if we work together and have these discussions and learn as we go along, I have no doubt that we will achieve that. So thank you to both of you for taking the time and for helping us along that path.
Thank you.
Good.
Thank
Keep
you,
up. Thanks, guys. Cheers in.
Thanks. Cheers.
Bye.